Okay, so I'm having this meeting purely because, one, I had it earlier and for some reason Zoom decided not to record it. So I'm having it again in order to make this recording so I can send it out to everyone that missed it. But I want to discuss primarily three main topics. All right, and we've got somebody else joining in, so I'll go ahead and let him come in. All right. Hey, so just getting started. You haven't missed anything. Just really going to talk about three main topics in this. The first topic is I want to discuss IRAs, also known as 401ks or retirement plans. And as part of that conversation, I want to talk about financial advisors. It seems like I have a lot of clients that are growing, and as they grow, they're getting disposable cash and they don't know what to do with it. I'm not really a financial advisor, so they don't really turn to me and ask me a whole lot of questions. And if they do, I typically point them to books. But then they go to financial advisors, and some financial advisors are good. It seems like some of them that they're going to are advertising good services, and then they're not really making par on being a good financial advisor, at least in my opinion. And so I want to discuss my reasonings for that and kind of how I personally feel about financial advisors. And I do that being I double majored in accounting and finance, and so I could have been a financial advisor. I didn't want to. Anyway, so we'll talk about that. The next topic will be about real estate investing and why I want to send clients down that road. And then the last topic I want to go into is just general market strategy and how to invest in the overall stock market and bonds and mutuals, funds, and stuff like that. Okay, so let's go ahead and get started. Just right off the bat, I'm going to say I hate 401ks. I hate IRAs. I think they are the biggest tax scam available. Why? Because they make you pay taxes until the day you die. So what's the point of an IRA or a 401k or retirement savings? They have many different names. There's simple plans. There's self-employed plans. I'd have to Google them to get all the names, but there's 4 or 5 different names for this. Really, they're all lumped into one category called a traditional IRA. And then there's another category called Roth IRAs. We'll talk about traditionals first. So a traditional IRA is the idea that you contribute money today to lower your taxes. And depending on the type of the plan that you're in, you could contribute up to something like $56,000 in 1 year. And it lowers your taxes today. And then when you reach age, I think it's 65 and a half, I'm not sure exactly what the age is, and it will probably increase before we get there. You are required to start taking minimum distributions each year. And when you take out a distribution, it becomes taxable. It is considered taxable income. The other thing about IRAs is if you withdraw the funds before you reach age 65 and a half, you get hit with a 10% early withdrawal penalty. So your money is locked away unless you're willing to pay 10% right off the top. Plus, when you withdraw it, it's still considered taxable income. It goes into your regular income bucket. So you will pay the 10% penalty. So if you withdraw, $100,000, you're going to instantly pay $10,000 penalty. And then that $100,000 gets put into your regular taxable income bucket. And, you could be in the 30% bracket. And so you're going to pay an additional $30,000 on it. So you pay $40,000 on this distribution of $100,000. So that means you get to use $60,000 of it. It's painful. Anyway, So that's kind of the idea behind an IRA. A traditional IRA is okay for traditional wage earners. All right, like the idea is that a traditional wage earner goes and gets a job right out of college, and they're making $40,000 a year, and then they start contributing to this IRA. They get a company match, and they're lowering their taxes. They start off in the 35% bracket, but because they're a college graduate and they're working at Microsoft and they're really good, they get promoted really fast, and eventually they're making $200,000 in the 40% tax bracket. And so they're paying into this IRA, they're maxing it out every year, and they're lowering their taxes every year at the 40% tax bracket. That's great, because then when they retire, they go from making $200,000 a year to like living off of the distributions from the IRA and Social Security. So they're making like $50,000 a year, maybe. They went from a 40% tax bracket down to a 25% tax bracket. That's good, because now they're paying deferred taxes on those IRA distributions at 25% instead of at the 40% when they were employed. That works out. We are not traditional wage earners. We are entrepreneurs. We are business runners. So what do? We go in, we build businesses that take forever to get started. We come up with ways to lower our taxes as much as we possibly can. And then we just keep growing our businesses. If you do sell, you get bored and you end up starting a new business and doing it all over again. Or you invest your money in other things like real estate or the stock market or something else. And what happens is you get to where you were contributing to this IRA at like a 25% bracket, to be forced to take it out when you retire because you still have a business and you still have multiple revenue streams. You're still in the 40% bracket. Now you're paying tax on an IRA at 40%. So instead of paying tax at 25% when you put it in there, you're paying tax on it at 40% when you pull it out, and you're required to pull it out. That's why I don't like IRAs. IRAs are what's called a tax deferment method. In other words, you're kicking the can down the road. The problem about kicking the can down the road is we really don't know what down the road's going to look like. And for most entrepreneurs, down the road means you owe more taxes. So what happens when you have an IRA as an entrepreneur? You pay taxes until the day you die at a 40% rate. And we don't like that. Okay, so that's a traditional IRA. Like I said, it locks your money into the IRA and you can't pull it out unless you're willing to pay that 10% penalty. So that's the other thing I don't like about IRAs, is that, yes, you can claim, oh, I have $200,000 in this IRA and it's an asset and it's great. But if you touch it, you pay a lot of extra taxes on it. That is restricted money that you can't use. So let's say you have a bad year in your business. Too bad, you can't pull your money out. You might have $200,000 in an IRA that you think, oh, great, I can use it. You're not going to get to use it because it's instant penalty if you pull it out. So that's the other reason why I don't like IRAs, is it restricts your money. So let's talk about a Roth IRA for a second. A Roth IRA is the idea that you pay the taxes on it today, and then when you pull it out when you're 65 and a half, you don't have to pay any taxes on it then. That's a better plan for entrepreneurs. It's the opposite. However, it still restricts your cash. You have that same issue that if you pull it out early, you end up having to pay tax on it, and you pay an early withdrawal penalty. And so we don't like that. I don't like having my cash restricted from me to not be able to use it should I need it. That's never sat well with me. And I'm not the only one that feels that way. So Tom Wilwright, he is an advisor for the Rich Dad Poor Dad group. He's their CPA. He's been a CPA for many years. He was on Trump's advisory team in the 80s. He hates tax deferment methods. He absolutely hates 401ks and IRAs. Why? Because they are a tax deferment method. They are the can down the road. His opinion, which is also mine, is if you have $50,000 to put in an IRA for a tax deferment method, you are better off using that $50,000 to invest into something that is a permanent tax savings strategy that won't come back and bite you later. And we will get into that in just a second. One of those permanent strategies of tax savings is real estate investing. So we will talk about that in just a minute. The other thing I want to talk about when it comes to IRAs is financial advisors. So financial advisors, they make money by advising you how to spend your money. And usually the way they do that is through commissions. That's one of their biggest revenue streams is commissions on managing your money. So what do they tell you to do? A financial advisor comes in and they look at your expenses and they come up with a budget for you in order for you to invest that money. And then when they tell you to invest, they want you to invest in an IRA. Why? Because they are money market managers and they make commissions off of you putting money in your IRA because then they manage it for you. So not only are you restricting funds so that you can't touch them, now you're also using those funds to pay somebody to manage them for you. So there is a conflict of interest there. What ends up happening is we have this thing that, like I said, I'm not the only one that believes this way, a tax scam that gets you pay taxes until the day you die at inflated rates. But now you have an actual group of people out there who make money off of you doing that. And so what do? They make it sound better than sliced bread, right? They sell it to you. Oh, you can save this much in taxes. Yeah, you can save some taxes today, but they don't tell you about the future. They make it sound like it's, God's gift to man, this 401k, because that's where their biggest revenue stream comes from. So they have a conflict of interest whenever they tell you put money in an IRA. So you got to remember that when you're talking to a financial advisor. The other thing with financial advisors, I actually agree with some financial advisors. I think they're great. They have a good purpose. That purpose being, let's go through your business income and expenses and come up with a budget for you. That's great. I am not a financial advisor. I do not even go through my own expenses and come up with a budget. I should, but I don't. I don't offer that as a service. And I'm definitely not the expert one to be able to do that for myself or anyone else. But there are people that are good at that. So hire them for that service. Help you come up with a budget and help you stick to that budget. But when they tell you to invest in an IRA, say, no, I'm going to invest in something else that's actually a permanent tax saving strategy. All right, so that would be one thing. The other thing I don't like about financial advisors is they like to use the status quo when it comes to payroll. Oh, you're in an S Corp. Well, an S Corp has to have an employee. Because you're an employee, let's run payroll for you. And we'll go ahead and just take $5,000 a month in payroll. You'll pay your payroll taxes on it. It's easy. We file your reports and you're good to go. We don't pay payroll because we're trying to get you cash out of your business. That's what a financial advisor is trying to do. He's trying to get you cash out of the business. The problem is he's using the status quo way of doing that. Payroll for us is purely a cross the T and dot the I, something that we have to do to keep the IRS off our back. And we do it by minimizing the tax as much as possible. I don't want you to pay a dime more than you have to. The only way I can do that is by knowing how much you make in your business. And we don't know how much you make in your business till the end of the year, okay? So everyone I've talked to, all my clients, I say, hey, take non-taxable distributions all year. At the end of the year, when we figure out exactly what your company makes, we will come up with the reasonable amount of what your payroll should be. We put that on the W-2 and we pay the payroll taxes for that. If you put $5,000 through a payroll processor every year or every month, you're going to have 5,000 times 12, $60,000 in payroll. Your company might have only made $65,000 for the year. And we didn't know that until December. You way overpaid your payroll. You way overpaid your payroll taxes. And guess what? I can't amend it. And so, yeah, the financial advisor wants you to do that because what he's trying to do is get you to put cash in your personal bank account to cover your budget. Better way to do that? Just do transfers. Transfer from your business bank account to your personal bank account. We classify them as non-taxable dividends from an S corporation to its shareholder, and we don't pay payroll taxes on it. That's what I'm aiming for. So when it comes to financial advisors, I butt heads with them all the time. Why? I hate 401ks and I hate the way they manage payroll. Everything else is usually okay. It's pretty good advice. Now, what I'm going to tell clients to do is I'm going to say, hey, look, before you go hire a financial advisor and pay people money, read the book called Profit First. And you can probably do a pretty good job on your own. And the idea of Profit First is you set up multiple bank accounts. When revenue comes in, you distribute that revenue to these different bank accounts. So that way you take your profit at the beginning. That's kind of the idea behind why they name it that. But it's really good about allocating your money to different accounts so you have enough to cover your expenses and different things such as taxes or payroll or whatever. Paul put in here, which is why you want us to pay as much from our business account first, then pay ourselves second. So most things are a write-off within reason. Yes, exactly. We want to, those are permanent tax saving strategies. We are aggressive in our business in order to lower taxes. Those are permanent tax saving strategies. We get aggressive, and then in the unlikely event that you're audited, we negotiate with the IRS. But as long as you're not audited, we don't have to worry about it. As long as we have legitimate business reasons for why we're taking those expenses. Yeah, that's a permanent tax saving strategy instead of let's be less conservative on your expenses in order to keep the IRS happy should you get audited and contribute $50,000 to an IRA to lower your taxes. That's a tax deferment method. And that's what a lot of CPAs do because it's easy. Keeps the IRS off our back, and I become an advocate for the IRS instead of for my clients. But yeah, that's exactly what most CPAs do that, and financial advisors do that. Because that's what they're used to. I don't do that, and so that's my opinion of it. But yeah, so read Profit First before you hire a financial advisor. I'm not sure exactly the author's name. It's Mike something. It starts with an M, but you can find it on Amazon. Profit First. Great book on how I don't agree with 100% of it. Mostly what I don't agree with is his percentages that he presents. And he suggests putting all this money in savings accounts. And we will talk about savings accounts too. We'll quickly talk about time value of money when we go into actual investing in the stock market and why I don't really like savings accounts. And so the issue with his book is you put too much aside for taxes than you probably should, and then you stick it in a savings account where technically it's losing value because the interest you make on that savings account is less than the inflation rate. So I prefer taking that cash and putting it in the stock market. And we'll talk about that in a little bit. Okay, so let's talk about real estate investing. So like I said, that is a permanent tax saving strategy. Instead of putting $50,000 into an IRA, let's take that $50,000 and put it into real estate investing. Why? So real estate investing is a very good way to become cash flow positive, meaning you have more cash in your pocket each month. But at the end of the year, when we file your taxes, you show a tax loss. So it lowers your taxes. Well, when it lowers your taxes, that means you're paying less taxes, which is a backdoor way of putting more money in your pocket. Okay, so the way this works is, let's say you go out and you buy a $300,000 home and you rent it out for $1,000 a month and the mortgage payment is $800 a month. And so you are cash flow positive, $200 each month. That results in $2,400 throughout the year. Cash flow positive, you're making $200 a month. Now, don't do the math on this, right? I mean, like, I don't know if an $800 mortgage payment would fly with a $300,000 home. And with the way the market is right now, you'd probably actually rent that out for like $2,000 a month than you would, So this is just an example. Anyway, so you're $200 cash flow positive at the end of each month. Okay. Then we have what's called depreciation. So depreciation is the lifespan of any asset. And the IRS designates what that lifespan is based on the type of asset it is. And so basically it's saying, like, if you have a car, the depreciable life of a car is 5 years. So if you go buy a $50,000 car, the IRS says, granted, this is back of the napkin math. The IRS has all sorts of crazy formulas for this that doesn't make it easy. But in theory, you take $10,000 of depreciation each year, because you take the $50,000, divide it by 5, you get $10,000 per year. So the idea is that you're writing off about $10,000 worth of that car each year because it's losing value over time. Same thing happens with houses or any real estate property. We have depreciation. Well, the depreciation life for residential rental property is 27.5 years. Again, IRS, 27.5 years. Why couldn't they just make it even like 25 or 30 years? I don't know. But what ends up happening is, because it's about 30 years and your mortgage on it's probably about 30 years, usually what happens is you get enough depreciation to equal your mortgage payment. And so taxes come out to be pretty close to real economic value of you're making $200 of cash flow each month. And so when you take that amount in depreciation each month, you get to still about $200 of taxable profit. But that's actually not correct when it comes to how you're supposed to depreciate stuff. The IRS doesn't challenge it when you do it that way because you're paying more taxes. The correct way to depreciate real estate is to do what's called a cost segregation. The cost segregation comes in and it says, look, yes, I have this house, and as a whole, it's a 27.5-year property. But in reality, this house is not just one thing. It is a bunch of components put together to make a whole. And those components are such things as like the HVAC system, the electrical system, the plumbing system, carpet, doors, countertops, kitchen appliances, paint. And then it comes, and so then it says, okay, you have this $300,000 home. We have all these actual different units that make up the whole. We're going to allocate that total purchase price of $300,000 a little bit to all these little different components. And then we're going to apply the actual regulated class life for each of those components. And so you have kitchen countertops. That's a 5-year class life according to the IRS. Or kitchen appliances. That's a 5-year class life. What happens is you end up front loading anywhere from 40 to 50% of the value of the home in the first 5 years of the asset, or that you're renting the property out. So if you're taking half of $300,000 is $150,000. If we divide $150,000 by 5 years, get my calculator to work here. That means you have a $30,000 depreciation expense each year. You are cash flow positive $200. Now, when we're doing things for taxes, in a mortgage, you can only write off the interest expense. You cannot write off the principal repayment. So let's say when we're doing your taxes, you have that $1,000 a month rental payment. Then you have that $800 mortgage payment, but you can only deduct $200 of interest expense. So that means you have $800 of taxable income on your rental property. $800 times 12 means you're going to have a $9,600 taxable profit on your property. Oh, but then we just added that $30,000 depreciation line. That results in a $20,000 tax loss If you're in the 40% tax bracket, that saves you $8,000 in taxes. So $100 or $1,000 a month revenue, $800 cash out in a mortgage payment, $200 cash positive. That's $2,400 a year of additional cash in your pocket. Then we file your taxes. This rental property just saved you an additional $8,000 in tax. That means you net $10,000 cash in your pocket because of this rental property. Oh, by the way, it's real estate. How often does real estate actually lose value? I mean, look at the market right now. Everything is blowing up. Now, granted, there will probably be a correction in a few years, but overall, real estate increases in value dramatically compared to anything else. So you're building equity in this property, even though you're writing off $30,000 of this expense each year. Then after 5 years, you used up half of the depreciation. If you don't sell, you will start paying taxes because now you're going to take like, $2,000 in depreciation. So what we do is we sell it. Trump is a real estate mongrel. And when he passed the new tax act in 2017, he got rid of all like-kind exchanges except for in real estate property. What is a like-kind exchange? A like-kind exchange is when you sell something and then buy something just like it. In real estate, that is any type of real estate. So you could sell a residential rental property and buy a parking garage. You could sell bare farmland and buy a condo. As long as it's real estate. Doesn't matter what type of real estate it is. When you do a like-kind exchange, the capital gain that you make on selling the property rolls into the new property and you don't pay a dime in tax. So normally when you sell a business property or an investment property, you sell it, let's say you bought it for $100,000, you sell it for $200,000, you have a $100,000 capital gain. In capital gain, long-term capital gain rates, it's 20%, you owe $20,000 in tax. Well, if you sell a $100,000 property and do a like-kind exchange and you sold it for $200,000, that $100,000 capital gain doesn't get taxed and it rolls into the new property. Well, now you have a new property. Let's say you bought it for $150,000. So it was, $150,000 works. That's fine. So let's say you bought a $150,000 property now. You add in a $100,000 capital gain to it. Tax-wise, the property's worth $250,000. All right. Now you can do a cost segregation again. You front load $250,000 worth of depreciation into the first 5 years, 50% of that into the first 5 years. So even though you had a capital gain, it increases the value, makes your depreciation even more, and you front load the depreciation again for the next 5 years. So what do? We buy a rental property, we own it for 5 years and rent it out, and then we flip it. And then we buy another rental property, own it for 5 years and flip it. Exit strategy. You die. Why? Because if you ever sell, all those capital gains will release and you owe the capital gains tax. But if you die, your inheritors, your kids, inherit all your assets at fair market value. Now, yeah, there's some estate tax and stuff, but we're not going to get into that. The idea is that they inherit at fair market value. And so they start all over. The next generation starts there. This is how the Rockefellers work. This is how the Trumps work. Name any super rich, multi-generational family in America, and this is how they work. They are landowners. And this is why Trump kept like-kind exchanges for real estate property, because he's using it. There's a reason why he only paid $750 in tax over the last 10 years, and everybody got pissed off about it. Why? It's because he has a bunch of rental properties. He's a billionaire because he has so many rental properties, and he's getting all that cash every month. But he's then doing cost segregations and taking a bunch of depreciation expense, wiping out all his taxable income and creating losses. Having a trust or having these in a trust, does it have any negative implications when they inherit the portfolio? No. In fact, that's exactly what I'm doing. I am starting a trust, multi-generational trust. I've already talked to an attorney. That's what I'm doing. All my assets will go into that trust. That way my kids can't squander their inheritance. But yeah, as long as it's in a trust, it's still protected. And if it's in the trust, then you never even have to worry about fair market value inheritance, because the trust then manages everything. And the trust buys a property and the trust sells a property. Okay. Okay. So that's kind of the idea behind rental real estate property. Now I have another client that has been putting together investment groups and doing this. I didn't do the math myself. He did it. It looked like it penciled to me. Because of historical appreciation in real estate property and the tax savings involved because of the cost segregation, he was showing an 80% return on investment. And we're talking the stock market historically gets 10 to 12%. 80%. You can't get that anywhere. Oh, by the way, IRAs, guess what they're invested in? Stock markets. So IRAs say, well, we can save you some taxes, but you'll pay those taxes later. And then you're going to get capital gains of 10 to 12%. I'm sorry. I would much rather take that $50,000. If I'm going to put $50,000 into anything where it's restricted and I can't touch it, I'm going to put it into real estate investing. Why? Because I'm going to get rental income in the process that I can spend, and I'm going to get an 80% return on investment on that $50,000. Definitely a better business decision. Yeah, so that's kind of the plan. The plan is we have our S corporation or our corporation operating business. We get as aggressive as we can in expenses to lower our taxes permanently year over year. We take that tax savings and that cash and we invest it in real estate properties. Then as our real estate property portfolio grows, suddenly we become the next Trump. Okay, maybe that's wishful thinking in the first generation, but you at least get big enough to where you have enough rental income coming in that you can quit your main operating company. You go hire a property manager and it's all passive money coming to you. And then you go buy your yacht in the Bahamas and live on your yacht while you're still making money, and you don't have to do anything. You're just paying people to manage your properties for you. Now, the question is, what happens if you don't have a renter in there? All right, you don't have a renter in there. So instead of having an $8,000 in tax savings, you have a you make no cash, so you lost the $2,400 in cash that you made each year, but you still are saving taxes. And because you had no $1,000 of rent income, you still had the same expenses. You're still advertising to rent this property. So even if there are no renters in it the entire year, you're going to get $9,000 of tax savings because there's going to be more expenses with no revenue. That means the tax savings increases. Okay, you're still getting a positive return on investment, even with no renters in there. It's still cash flow positive. Okay, so let's talk about the next step. So some of us probably don't have enough cash available to just go put money as a down payment on a rental property. So what do? Most of us like to shove it in a bank account. Well, as I said before, we have this thing called time value of money, and that involves inflation. No bank is going to pay you more interest than the inflation rate. Why? Because banks have to turn a profit too. So they take your money, they use it for things to make them more money, and then they pay you an interest rate. A savings account is getting like 1.5% interest. Inflation's about 3%. That's usually what it is year over year. It hovers around 3%. You might get 1.5% to 2%. Your money's losing value sitting in a bank account. So what do? Let's go open an E-Trade account or a Charles Schwab account. We don't need a money market manager. Why? They cost money. They make you pay commissions every time you buy. They take a commission. Every time you sell, they take a commission. Or when they buy or sell for you, they take a commission. So we don't use money market managers. We use self-managed investment accounts. Robinhood might work. I've never used Robinhood, so I don't know exactly what their platform is. Look at the commissions that you're paying when you use Robinhood. But yeah, Charles Schwab and E-Trade are very good platforms. They have very low commissions because you're managing it yourself. The market, on average, has gotten a 10 to 12% return on investment or capital gains since the beginning of keeping records of the stock market. That includes the Great Depression, the recessions, all market corrections, booms, and slumps, right? The stock market does this over time. And really, it's doing this when you flatten out that curve and look at it from a long-term perspective. Okay, so let's talk about the stock market. I take an academic approach or theory to looking at the stock market. So let's talk about what is the stock market. The stock market is nothing more than an auction house. All right, so I like to use GameStop as an example because it was in the news a lot recently. And it was in the news because a bunch of people on GameStop artificially or incentivized or made people think they should go out and buy GameStop stock in order to save GameStop. And it artificially raised the price. Well, GameStop is over here. And when they sell stock, it's called an initial offering. And they make that sell to specific people. And then those people go over into the stock market and sell. The stock market is a second-hand store. It is an auction house. And so all those people artificially driving up the stock market, all they did was make other people rich, not GameStop. Okay, so we could make this in terms of, let's talk about the auction house. GameStop is a furniture store, and they sell a Lazy Boy. And this Lazy Boy, when sold brand new, is $1,000. Well, somebody has a Lazy Boy and they decided to take it to the auction house and sell it. Now, I'm at that auction house. I would be what you call an informed investor. What did I do before going to the auction house? I saw that Lazy Boy was for sale there. I thought, I want to buy a Lazy Boy, but I'm going to do my research before I go to the auction house. I'm going to go to that furniture store and see how much they're selling that actual Lazy Boy for brand new. Oh, it's $1,000. Okay, I'm going to go back to the auction house now and I'm going to stand there. Well, people get auction crazy and they overbid it and it sells for $12,000. I stopped bidding at $800. Why? It's secondhand. I think I would rather go buy a brand new one for $200 more than I would buy the secondhand Lazy Boy for more than $800, but it sold for $1,200. Why? Because there was a bunch of uninformed investors there that didn't do their research beforehand. So what happened with GameStop? They're the furniture seller. They have a bunch of Lazy Boys for sale, and they looked over at the auction house and went, why are people buying these used Lazy Boys for $15,000 or $1,500? So what they did was they maybe filled up a small truck, drove it over to the auction house, and sold a few. They didn't sell a bunch. They sold a few. Okay, so they did get in on it. They didn't get on it very much. Okay, so the idea of the stock market is this auction house has millions of people there. There are literally millions of people in the world investing in the stock market. And they're expecting that 99% of those investors are informed investors, meaning they've gone and done their research. And when they come in, they're not going to pay for a stock if it is overvalued. Okay? That's kind of the general theory. So then what happens is if the informed investor knows that's the case and they're not going to buy a stock if it's overpriced, then there's 1% to 10% of the investors that don't have a clue, don't know what's going on. They didn't do their research and they artificially drived up GameStop stock. That's when money market managers come in. They come in and they say, I'm going to bet on this stock, hoping that there's a dumb investor out there that didn't do their research that are going to artificially play with this stock. And that's where they try to beat the market. Okay. That's what they're trying to do. They're trying to beat the market. Their idea is that the market's not full of informed investors. The market's full of idiots. And I'm the only informed investor. So I'm going to outsmart all these idiots and I'm going to make a profit off of them. You're better off going to Vegas and just playing the jackpot or playing the slot machines and hoping to win the jackpot. Why? Everybody eventually loses. Here's the example that we used when I was in college. This is the example my professor used. So if we have this idea of most people are informed investors and they understand how much a stock is actually worth, that means all these money market managers are betting against stupid people. They're basically flipping a quarter. So here's the example. We go load up an entire stadium full of people. Every seat is filled. And then you tell everyone to stand up, pull out a quarter, and flip the coin. And then you say, everybody with heads, sit down. Laws of statistics, about 50% of the people are going to sit down. And then you say, flip again. Statistics say about 50% of the people are going to sit down. And then you keep flipping and you keep flipping and you keep flipping. Somehow there will be somebody just based on the laws of statistics that will still be standing after 10 or 20 flips. They will have somehow gotten tells every time. That's the money market manager that ends up on the cover of Forbes magazine saying, hey, I made all my investors billions of dollars this year. But the next time they flip, it's still a 50-50 chance. And they lost that time. And now everybody that's in their investment group lost their pants. It happens all the time. Very rarely do you see that same money market manager on the cover of Forbes magazine year over year. It doesn't happen because there are informed investors out there that know better. Okay, so what do? We invest in what's called index mutual funds. All right, so what's a mutual fund? Mutual fund is what we call using diversification. And what that is let's use the auto industry as an example. And I go out and I buy stock in Ford and I put all my money in Ford, hoping it does okay. Well, then there's a recession in the auto industry and Ford is the only company that goes bankrupt. I lose all my money. Now, we know that the auto industry itself is not going to go completely bankrupt. If Ford goes down, that means there's still people out there buying Chevy or Toyota or Nissan or Volkswagen or whatever, right? They're still out there buying them. Why? Because there is still a need for vehicles. So let's say the industry supports 1 million vehicles every year. If Ford goes down, somebody else has to pick up that slack, and there is still 1 million vehicles getting sold. Now, the industry as a whole might fluctuate. 1 year there's a need for 2 million vehicles, and the next year there's a need for 500,000 vehicles, right? The whole industry might fluctuate. That's fine. But even though the whole industry is fluctuating, if I put all my money in one company and it goes down, I'm screwed. But if I put my money in the whole industry, so I go out and I buy GM, I buy Ford, I buy Toyota, I buy Volvo, I buy Volkswagen, then I get the whole industry. And so if the industry does well, I do well. If the industry does bad, I do bad. So then the next thing I do is I invest in multiple industries. Then if one industry does good, I do good. And if one industry does bad, I do okay, because this other industry is going to do good, right? And then the only way that I really start to hurt is if the whole market does good or does bad. And as we've stated, the market as a whole has increased over time at about 10 to 12%. So as long as I'm diversified through the entire market, I'm going to do okay. And we do that through mutual funds. Mutual funds are the idea that you're investing in multiple things. And a mutual fund, they originally were started by money market managers. And what they do is they would say, I know you can't afford to buy stock in 500 different companies. So give me $10,000 and I'll have these other 100 people each give me $10,000. And then I will have the money to invest in 500 different companies. And then you will own 1% of the mutual fund. And so you will get the mutual fund returned. Well, now you're paying commissions to this guy to manage your money. That hurts. Commissions can get expensive. And a lot of times the commissions are hidden. They don't always state them. You have to like dig through what's called the prospectus. Those are like 100-page documents before you can find what all the actual commissions are. They're not easy to find. So the next thing that happens is they invent these things called index mutual funds. And an index mutual fund is a computer managing it. And it's based on algorithms. Well, computers don't need commissions. So it really minimizes the amount of commissions that you pay. The way these things work is there's like the S&P 500, which is the top 500 companies in the US, the 500 biggest companies. Those are ranked every quarter based on their filings with the Security and Exchange Commission and other factors, right? Well, the computer looks at those factors and those filings and says, oh, based on the algorithm, these are the companies I'm going to buy in. And then you get the S&P 500. The S&P 500 does well, you do well. The S&P 500 does poor, you do poor. But if the S&P 500 is doing poor, the entire world's doing poor, basically. It's a very, very safe bet. All right, so that's the idea of an index mutual fund. Now, personally, I invest in 4 index mutual funds. The first one is the Vanguard Index S&P 500. All right, top 500 companies in America. The next one is the Vanguard Index Small Cap or Small Capitalization Fund. And small capitalization means small companies. They don't have another term for capital is cash. All right, so they don't have large cash. They have small cash. So they're the up and coming companies. A little bit more risk because small companies fail a lot more than big companies. So the small cap index fund typically has a higher rate of return than the bigger one. But it's a mutual fund, so you're invested through the entire market. It's still a pretty safe bet, but you get a higher return. Then I invest in the Vanguard Index Dividend Fund. Why? I like dividends. Dividends put cash in my pocket, and then I can take that cash out of my E-Trade account and spend it if I want to, or I can reinvest it. I just like having dividends. That's personal. And then the last one I invest in is the Vanguard Index International Fund. Now I'm diversified through the whole world. I'm in the big companies, the small companies. So if the US does well, I'm doing well. If the US big companies do well, or if the US small companies are doing well, it fluctuates. But then I'm invested in the entire world. So that way, if the US is doing poor, China's probably picking up the slack and I'm invested there. Or Brazil's picking up the slack. Or I don't know, the EU's picking up the slack. Now there might be a worldwide recession. That happens. But if there's a worldwide recession, I just don't sell. I keep my mutual funds and eventually the market will correct and continue to grow. It has year over year, it goes down and then it goes back up. And when it goes back up, it goes back up higher than it was. All right. So that's kind of the approach is we have our operating company. The goal is to get out of this operating company into 100% passive income in real estate rental properties, and I become an empire of landlord empire. And to get there, I invest my disposable cash in the stock market using those 4 investments. That's kind of that's how we get there. So then I build up my You know, if I have a tax savings account, it's in my investment account. If I have a profit account, it's in my investment account. That's where my disposable cash is. That's where I pay my taxes out of. That's how I, you know, I build up that fund. And then when I'm ready, I sell and I go buy rental property. Okay, so that's the direction we're going, and that's how we get there. So that's really my take on investments. It's very simple. I like to follow the keep it simple, stupid method, the KISS method, and really it doesn't need to be complicated. That's what we aim for, and we use permanent tax saving strategies to get there. Number one being rental real estate properties. Okay. There hasn't been a whole lot of questions. If you have any questions, feel free to shoot them out. But we're at about our hour mark. And that's really all I have. Okay. I don't see any questions coming. I'm going to go ahead and end recording. If you two have any specific questions, you're welcome to present them.